201%, that's how far T3 defense shares rocketed today, tripling in a single session. But the number that should really worry retail investors is $11.5 million, the size of Datadog CEO Olivier Pommel's stock sale this week. Today, why the Dow ripped higher while the Nasdaq slipped, what that insider sale really signals, and the 3 stories moving your portfolio right now. Let's start with the tape. The S&P 500 closed at 7,413.43, essentially flat, up just 0.02% on the day. The Dow Jones Industrial Average was the standout, jumping 0.51% to 52,210.08, that's roughly 260 points of gains. The Nasdaq Composite lagged, down 0.18% to 24,932.08, as megacap tech cooled off. The VIX ticked up 0.48% to 18.67, still historically calm, but a sign traders are buying a little more protection. Under the hood, defensives led, consumer defensive stocks gained 1.48% on average, the best performing group we're tracking. On the other side, basic materials dropped 1.07%, consumer cyclical fell 1.01%, and energy slid 0.66%. That's a classic rotation pattern, money moving out of cyclical, growth-sensitive names and into safety. That rotation lines up with sentiment. The CNN Fear and Greed Index sits at 40, squarely in fear territory. Investors are cautious even with the Dow at highs, and today's sector split tells you exactly where that caution is showing up. Story number 1, Datadog's Insider Watch. CEO Olivier Pommel sold 47,054 shares across 7 separate transactions on July 23, worth $11,518,401. He wasn't alone. Director Amit Agarwal sold another 20,000 shares for $4,897,334 on the same day. 2 insiders, 7-figure sales, same trading day. That's not a coincidence, that's coordinated timing, likely tied to a preset trading plan or vesting schedule rather than a sudden loss of conviction. There's no cluster of insider buying to offset it in our data, which means the flow is one-directional, out. For retail holders, the takeaway isn't panic. CEOs routinely diversify concentrated stock wealth, but it is a flag to watch Datadog's next earnings print closely. When a CEO and a board member both sell multi-million-dollar stakes in the same week with zero insider buying to balance it, the stock needs to prove its valuation with results, not sentiment. Story number 2, MapLight Therapeutics collapsed 72.9% to $9.905 today, and here's the paradox, the company's schizophrenia drug actually hit its phase 2 primary endpoint. That's a clinical win. So why did the stock get cut by 3/4? 2 reasons in the data. First, the market had priced in a much bigger beat, and merely meeting the endpoint without blowing it away triggered a classic sell the news reaction. Second, and more serious, is a headline hitting the wire the same day: a fraud investigation into MapLight is being opened by SBS Law for investors. When a stock craters on good clinical news, that's usually not about the science anymore, it's about trust in the disclosures. This is a name to avoid until the legal question is resolved, regardless of how the drug trial actually performed. Story number 3, Entera Bio surged 91.2% to $3.92 after pricing an oversubscribed $275 million private placement. Normally, a placement that size, many times the company's market cap, would be dilutive and punish existing shareholders. Instead, the stock nearly doubled. Why? Oversubscribed means demand from institutional buyers exceeded the shares on offer, and that demand comes right after positive FDA feedback last month on Entera's phase 3 oral osteoporosis pill. The market is reading the raise not as desperation for cash, but as smart money front-running a de-risked regulatory pathway. The lesson for investors: not all dilution is bad news. When a financing round is oversubscribed and follows real regulatory progress, it can signal conviction from sophisticated capital rather than a company scrambling for a lifeline. Turning to Capitol Hill and corner offices. Senator Alan Armstrong disclosed 3 sales on March 27, revealed July 21, Teledyne Technologies, PNC Financial, and Phillips 66, each in the $50,001 to $100,000 range. He also picked up Commonwealth Bank of Australia shares worth $15,001 to $50,000 the same week, trimming U.S. industrials and financials while adding international banking exposure. On the House side, Representative William Timmons bought SpaceX shares worth $50,001 to $100,000 back on June 15, disclosed July 20, a bet on the private space sector ahead of Reddit's current SpaceX chatter, which is up 371.8% in mentions today. On the insider side beyond Datadog, Aqua Capital bought 120,000 shares of Energizer Holdings for $2,473,994 on July 24, a real insider buy with no offsetting sales in our data, worth noting. Meanwhile, SRB Corp sold $4,003,019 of safety insurance, and Weatherford International Director Neil Goldman sold $1,357,426. Sells are outnumbering buys again today. No U.S. companies reported earnings today. But the calendar ahead is heavy with semiconductors, which matters given Reddit's most mentioned ticker today is Micron, up 1,376% in mention volume, alongside Nvidia up 3,100% and SanDisk up 1,566% in chatter. That retail attention lines up directly with this week's earnings. Samsung Electronics reports July 30, with analysts modeling EPS around 11,123.191 and revenue near 170.94 trillion won. SK Hynix reports even sooner, July 29, with EPS estimated at 70,975.381 on revenue near 84.17 trillion won. Both are critical bellwethers for the memory chip cycle driving the entire AI hardware trade. If SK Hynix or Samsung beat on memory pricing, expect Micron and SanDisk to move in sympathy when U.S. markets open Wednesday. On the data front, today's durable goods orders for June came in at just 0.3%, badly missing the 2.5% estimate, while the ex-transportation reading rose 0.6% versus 0.8% expected, both soft. The offset was the Dallas Fed Manufacturing Index, which jumped to 1.3 versus a forecasted contraction of -1, a genuine upside surprise for regional manufacturing. Tomorrow, July 28, watch retail inventories ex-autos, estimated at 0.3% month-over-month, and wholesale inventories, estimated at 0.2%. Inventory builds matter right now because they feed directly into GDP calculations and tell us whether businesses are stocking up in confidence or getting stuck with unsold goods amid this durable goods slowdown. Bottom line, a fear gauge market rotating into defensives while insiders sell and speculative small caps swing wildly. Subscribe for tomorrow's recap.